There's a $20 bill in your wallet right now that's worth less than it was when you woke up this morning. Not because you spent it, not because someone stole from you, but because while you were sleeping, someone, somewhere, pressed a button. And that button didn't just affect your $20. It affected every dollar, every price tag, every savings account, every retirement fund, every mortgage payment in the country, all at once. This isn't a conspiracy theory. It's monetary policy. And the button? It's real. It's called the federal funds rate. But here's what they don't tell you when you're learning about inflation in school. The button doesn't control prices. It controls time. Let me show you what I mean. In 1971, something strange happened to money. The United States severed the last connection between the dollar and gold. For the first time in history, the world's reserve currency wasn't backed by anything you could touch. It was backed by a promise. A very specific promise that the people managing it would be responsible. But responsibility is a funny word when you're talking about a system designed to lose value. Because that's the part nobody says out loud. Your currency is supposed to depreciate, on purpose. By design, 2% per year is the target, the goal. They call it inflation, I call it a timer. And once you see it, you can't unsee it. Here's how the timer works. Every dollar in existence is essentially borrowed into existence. Someone, somewhere, took out a loan, a mortgage, a car payment, a credit card balance, a government bond. When a bank makes a loan, it doesn't take money from a vault and hand it to you. It types numbers into a computer. New money, created digitally, added to the total. But here's the catch. That loan comes with interest. Let's say the total amount of money in the economy is $100. But the total amount owed, including interest, is $105. Where does that extra $5 come from? It doesn't exist yet. Which means someone has to borrow more money to create it, which adds more interest, which requires more borrowing. It's not a bug. It's the system. Money must grow or the system collapses. And growth requires one thing: time. That's what inflation really is. It's not just rising prices, it's the cost of keeping the machine running. Every year, the money supply expands. Every year, your purchasing power contracts. The timer ticks down. You don't notice it day to day. You notice it when you're 50 and the house you could have bought for $60,000 now costs $600,000. Same house, different timer. Let's do some uncomfortable math. If inflation averages 2% per year, your money loses half its value every 35 years. That's the rule of 70. Divide 70 by the inflation rate and you get the number of years until your purchasing power is cut in half. 2% sounds harmless, almost boring, but compounded over a lifetime and it's devastating. $1 in 1980 is worth about 25 cents today. $1 in 1950 is worth about 8 cents. Go back to 1913, the year the Federal Reserve was created, and $1 then would be worth only a few cents today. Nearly all of its value. Gone. Not stolen. Evaporated. Designed into the system. Now here's where it gets darker. That 2% target? It's arbitrary. There's no law of physics that says inflation must be 2%. For long stretches of history, prices were stable or even falling as productivity increased. Deflation wasn't always a crisis. It was normal. But in a debt-based system, deflation is catastrophic. If money becomes more valuable over time, nobody borrows. And if nobody borrows, no new money gets created. The system freezes. Debts become unpayable. Banks collapse. So the central bank has one job: keep the timer running, keep people borrowing, keep the money supply growing. Even if it means your savings slowly bleed out. This is where the button comes in. The Federal Reserve doesn't print money directly. That's a common misconception. What it does is set the price of borrowing, the interest rate. When the Fed raises rates, borrowing becomes more expensive. People take out fewer loans. Less money gets created. The economy slows down. The timer ticks slower. When the Fed lowers rates, borrowing becomes cheaper. People take out more loans. More money flows into the system. The economy speeds up. The timer ticks faster. They call this the business cycle. Speed up, slow down, expand, contract. It's really just the rhythm of the timer. And here's the uncomfortable part. The people controlling the timer are making their best guess. They don't have a crystal ball. They're looking at data that's weeks or months old. They're running models based on assumptions that might not hold. There are 12 people in a room in Washington making decisions that ripple through 330 million lives. Sometimes they get it right. Sometimes they don't. In the 1970s, they got it wrong. Inflation surged into double digits. The timer sped up so fast people could watch their savings evaporate in real time. In 2008, they nearly let the timer stop completely. The financial system almost collapsed. They had to create trillions of dollars in a short period just to keep the machine alive. And in 2020, they did it again. They created massive amounts of new money in just a few years. The timer went haywire. Inflation spiked. Wages couldn't keep up. Housing became unaffordable. Everyone felt it. They'll tell you it was necessary. They'll tell you the alternative was worse. And maybe they're right. Or maybe we've built a system that requires constant crisis management just to function. Let's talk about who really pays for this. Inflation is often called a hidden tax. And it is, but it's not evenly distributed. If you own assets, stocks, real estate, commodities, inflation often works in your favor. Asset prices rise with the money supply. You get wealthier without doing anything. If you hold cash, if you live paycheck to paycheck, if your income is fixed, inflation crushes you. Slowly, quietly, year after year. This is why wealth inequality keeps growing even when the economy is technically doing well. It's not a bug. It's not corruption. It's math. The timer benefits asset holders and punishes savers. The middle class used to be able to save their way to security, put money in a bank account, let it grow, buy a house, retire comfortably. That worked when interest rates were higher than inflation, when saving was rewarded. But for much of the last 15 years, interest rates have been extremely low. Your savings account pays you almost nothing. Meanwhile, inflation eats away at 2, 3, sometimes more % per year. You're losing money by saving it. The system is sending a clear message. Don't save, borrow, spend, invest, take risk, because holding cash is a guaranteed loss. And if you can't take risk, you fall behind. This is the game, and most people don't even know they're playing. Now zoom out. The dollar isn't just America's currency, it's the world's currency. Oil is priced in dollars. International trade is conducted in dollars. Foreign governments hold trillions of dollars in reserves. Which means when the Fed adjusts the timer, the whole world feels it. When the Fed raises rates, dollars become more valuable. Other currencies weaken. Emerging markets that borrowed in dollars suddenly struggle to pay their debts. Countries fail not because their economies collapsed, but because the timer changed. When the Fed lowers rates and creates more money, those dollars flood into global markets. Asset bubbles form. Real estate in cities like Vancouver, London, and Sydney explodes in price. Not because of local demand, but because of global dollar liquidity. The Fed doesn't just shape the American economy, it heavily influences the global economy. And the rest of the world has no vote. This is the power of the reserve currency. It's also the risk. Because if confidence in the dollar ever breaks, if the world decides the timer is broken, there's no guaranteed backup system. Other countries know this. That's why they're building alternatives. Digital currencies, gold reserves, trade systems that bypass the dollar. The timer has been running for decades, but nothing runs forever. So where does this end? There are really only 3 possibilities. 1, the system continues. The timer keeps ticking. Inflation stays manageable. Central banks maintain control. Debt keeps growing, but never collapses. This is the optimistic scenario. It requires near-perfect execution, indefinitely. 2, the timer speeds up. Inflation spirals. Debt becomes unpayable. Confidence breaks. The currency fails. This is hyperinflation. It's rare, but it has happened before. 3, the timer stops. Deflation takes hold. Debt collapses. The financial system freezes. This is what nearly happened in 2008, the nightmare scenario for central banks. None of these outcomes are guaranteed. But one thing is, the timer will keep ticking until it doesn't. That $20 bill in your wallet isn't money. Not really. It's a claim on future productivity. A bet that the system will keep running. A promise that someone, somewhere, will accept it tomorrow. But every day that passes, the claim gets smaller. The bet gets riskier. The promise gets harder to keep. You can't stop the timer. You didn't build it. You don't control it. But you can see it now. And once you see it, every financial decision looks different. Every price tag has a hidden variable. Every savings account has a countdown. The timer is inside every currency, every system, every economy built on debt and promises. The only question is, how much time is left?